The 50-year mortgage. Most people hear 50-year mortgage and think it's a magic fix for high rates. Stretch the term, drop the payment, boom, problem solved. But that thinking misses the full story. This product changes more than the monthly payment. It changes the math, the risk, and the long-term cost. So before buyers jump in and before agents start recommending it, we need to slow down and look at what this really means. So let's start with the simple truth. A longer loan term lowers the payment but raises the total interest. That's the trade-off. And a 50-year loan pushes that trade-off farther than anything we've seen in the mainstream market. Break it down in plain, simple steps that buyers can understand. Here we go. The payment looks easier because the loan gets stretched out and the monthly number drops. Buyers feel like they can breathe, and this is why the idea is getting some attention these days. People are tired of fighting affordability. So the equity builds slower. On a 30-year loan, the first few years already moves slow, right? Then on a 50-year loan, it crawls. You're paying mostly interest for a very long time. That slows the wealth building. It also makes it harder for someone to sell earlier if the market shifts. The interest cost grows, right? So the total price tag of the home becomes much higher when you spread it across 5 decades. Buyers need to see the lifetime math, not just the monthly payment. So this is not a standard product right now, okay? This is just like the hot news. So right now the 50-year option shows up in niche programs, portfolio loans, private lending channels. It isn't conventional yet. It isn't like FHA, VA, USDA. It's not even backed by the big agencies yet, but that's coming. That means stricter guidelines in some places, looser guidelines in others, and more variation in rates and fees. And the risk is different. A long-term goal exposes a buyer to more unknowns, like job changes, moves, family needs, housing cycles, and almost nobody stays in a home for 50 years, not even 30. So most people will move within 7 to 10 years, so the idea that this becomes a 50-year plan isn't realistic. It's really just a short-term payment strategy that carries a long-term cost. So the buyers can feel a little squeeze. Prices didn't drop, rates didn't break the way they hoped, so when they hear about a 50-year loan, it feels like hope. But hope without clarity becomes a trap. So ask the simple questions that any smart buyer should answer. Can you handle the upfront savings but accept the long-term costs? What's your real timeline in the home? Do you plan on refinancing the moment rates fall? Do you understand how much equity you'll gain each year? Does a lower payment justify the higher lifetime costs? And here's some other options to consider. A 2-1 buydown. It gives real payment relief up front without locking into decades of extra interest. Strategic pricing. Some buyers qualify stronger with a small price adjustment, not a massive loan term stretch. Debt cleanup. Reallocating payments from other debt, it boosts your debt to income ratio and saves more money than a 50-year stretch. And down payment assistance when available. Some programs reduce the initial burden enough to stay with a standard term and also then go in with a temporary refinance strategy. So if someone plans to refi when rates drop, locking into a 50-year loan just makes the end-term period more expensive than it really needs to be. And for realtors out there, agents drive the first conversation with the buyers. When a new loan product hits the news, buyers ask agents first. Agents who understand the trade-offs build trust much faster. Agents who explain the why behind the affordability position themselves as advisors, not just door openers. This product becomes a chance for agents to stand out by giving honest guidance instead of just chasing hype. So here's the mindset shift. A 50-year loan isn't good or bad by itself, it's just a tool. But tools require understanding. Some buyers will use it wisely, most will not. Your job is to help them slow down, understand the cost, and make decisions based on their future, not their fear. Buyers don't need noise, they need clarity, and clarity builds confidence. Confidence leads to better choices create stronger clients and stronger partners. The 50-year mortgage will get headlines, it will create curiosity, it will feel like the easy button for people frustrated with today's market. But easy buttons rarely build long-term stability. Encourage the buyers to ask better questions, show them the full math, help them understand how today's decision shapes tomorrow's freedom, and if you want to stay ahead of the shifts like this, just follow along. I'll keep breaking down every new trend so you can lead your clients with confidence, not chaos, and let's raise the standard together.